when to look at investment property, you will see that if you understand what we did on PPE, you will see that there is no much, there's a difference, but the difference is not much in terms of presentation. So the only difference between investment property and PPE is that investment property, it earns income on its own, like rentals, capital appreciation, where you buy land, assuming that it will appreciate, then you keep it for years, and then after those years, you can now sell it. So it's investment property. So the only difference between investment property and property, plant and equipment is we use PPE to produce income, whereas investment property, it produces income on itself. I think that's the major difference between the two. So in investment property, we get income from the investment property itself, rather than using it to generate, to produce income. So that's basically the difference between the two. So let's quickly go through the notes. I want us to look at a long question so that we can familiarize ourselves with long questions in the exam. So investment property is property held to earn rentals or capital appreciation. It is not held for use in production or supply of goods or for administration purposes. So that is our investment property. Right, so let's look at the terms. I think carrying amount, we did it when we were doing PPE. But you will see there's a difference between the carrying amount of investment property and the one for PPE. You will see that the carrying amount for investment property will increase. This one will increase instead of decreasing. Most of the investment property, they increase in value. Then the cost of the investment property is more or less like PPE. So which means we're going to have the cash paid. Let me just go down. Right, so on the cost of investment property, let's look at here. So which means in your question, you look at the cash purchase price, directly attributable expenditure. So all these, if they are in the question, it means they are going to add to the cash price to come up with the cost of the investment property. Remember, when we talk of cost, we are talking at the initial measurement. Remember, we did this when we were doing PPE. So which means when you get the investment property, this is how much you are going to record in the books of accounts for the organization. So don't forget, always when they provide you with the purchase price, also look for anything that can increase the cost of the investment property. So that's what you are going to record when you record in your books of accounts, right? Then fair value, I think we did it when we were doing PPE. So the fair value is the price that we can sell an asset. So in terms of investment property, you don't determine the fair value. You should look for a professional person who can evaluate the property. So that would be the fair value of the investment property. Then there's a situation where we have what we call abnormal credit terms. Abnormal credit terms are terms where the payment is going to be deferred. For an example, you buy your investment property, let's say the purchase price is 400. then because you are going to pay maybe after 1 year or 2 years, then there is going to be interest. So this one you need to be careful in a question. If the questions say the payment is going to be deferred to a certain period, then it means you need to separate the present value and the interest. That's where you can now use your financial calculator. So which means as long as there is going to be a deferred payment of the investment property, you are not going to record the full amount because part of the amount will be interest. So in that case, it means you need to split between the interest and the cost. The cost will be the present value of the asset. Then you split your interest, you take it to the profit and loss as an expense. So that's another key area when you have a question that defer a payment. Look if there is interest, if there is N, if there is FV, then it means you are going to calculate the present value. So that present value is going to be the cost of the investment property. They like to bring in this kind of question. So in a question, look at, they will provide you with interest and the date when the payment is going to be done. So once you see such a question, then you know you cannot record that full amount because part of the amount is going to be interest. So in that case, you need now to split between the interest and the present value of the assets. So that's abnormal credit term. So you can see from a question that there is an abnormal credit term where there is a deferment of payment, and they will tell you about the interest and also the period which they are going to pay for the investment property. I think it's here. You will see all the total installments payable less present value of future cash flow. Then the difference is going to be interest. So which means in your asset book for the organization, this is going to be the cost, the present value of the future cash flow. It's going to be the cost of the asset. So investment property, generally, it affects our statement of financial position and also our statement of profit and loss. You will see that the income generated or the fair value adjustment of the investment property is also going to be income in the hands of the organization. Right, so let's look at this small activity. Okay, they say they have got a property from a registered VAT vendor, which the details are as follows. The cost price including VAT, the cost price including VAT is 695,400. Then we have the agent's commission, legal fees, expenditure to upgrade the property. Then they say Pregin Limited is a registered VAT vendor. I think you guys from your text, you know when someone is a VAT registered vendor, it means they can claim input tax. So if people can claim input tax, it means if the cost price is including VAT, when you record in the books of accounts of the organization, you need to take out the VAT. That is, if we are registered VAT vendor, we need to take out the VAT from the cost. But if we are not, then it means we are going to bear this full cost because we cannot be able to claim input tax. So in your question, always look, as long as something is to talk about VAT, look at the, are they registered VAT vendor? So that when you calculate the cost of the asset, then you know how to treat that VAT. I think from your checks, you understand this VAT input and VAT output and the registration of an organization as a VAT vendor and the advantage of being a VAT vendor when it comes to purchase of assets. So which means you are going to claim input tax. So in your cost, you don't include that in the cost of the asset because you get the input tax. Right, so they say the intention of pre-gain is to rent this property out and earn rental income. These are some of the keywords when you are, remember I said AIS 16 and AIS 40, the questions will be mixed. It will be one question mixed. So what is important is for you to be able to identify this is investment property, this is PPE. So if the question says the intention is to rent this property out and earn rental income, then you know it's going to fall under AIS 40. So if the property is used by the organization as administration buildings to earn income, building to use in the production of income, then you know that is going to fall under AIS 16. And if it is a question in the exam, you don't mix AIS 40 and AIS 16. Even if the question is one and it combine the two, so which means you should split the two and come up with all those assets that goes to PPE and all those assets that goes to investment property. So when you do your disclosure of PPE, it means you should select everyone who goes to PPE and everyone who goes to investment property. Then you answer it that way. So that's basically another key area, because these guys, they need to consolidate the question. So we should be very careful when you read the question, whether it's investment property or it's PPE, right? So the question requires us to calculate the initial cost at which the investment property must be recorded. They also say the incurred cost to the amount of 18,000 to secure the tenants. So they want us to calculate the cost that we are going to record this investment property. So how do we determine the cost of the investment property? From what we have just talked about, what I want you guys to see is here. How are we going to treat agents commission? How are we going to treat legal fees? How are we going to treat expenditure to upgrade the property? So which means this is going to make up the cost of the investment property. But what about this cost to the amount of 18,000 to secure a tenant? Is it going to be part of the cost of the investment property? Based on what we have just done, is there anyone who has got an idea? From what we have just looked at, is it going to be part of the investment property's cost? The 18,000 cost to secure tenants.
I think that one it's a period cost.
It's an expenditure. Yeah, it goes to profit and loss, ne?
Yes.
So if the question like this, because in this kind of a question, they will ask you to disclose the investment property, disclose this in the investment property, which means all these which are going to be period costs, you take them to the profit and loss. Then the investment property, you now take them to the statement of financial position. When you take the investment property, to the statement of financial position. It means you need one, the initial recognition, then you will need the subsequent recognition or recognition after this initial recognition. So which means that's how you take it to your investment property, which means here you are going to look at the cost of the investment property. Here you are going to look at if it is measured at fair value. So it means you are going to look at fair value adjustment. Remember, we say we can measure using the cost model or the fair value model. So most of the investment properties based on your FAC3764, but you'll see when you do your CTA that there's something that is going to be added. But based on FAC3764, most of your investment properties are measured at fair value, which means you look at the fair value adjustment. The fair value adjustment is now going to increase the carrying amount of the investment property, which means from the cost, you will see that the cost maybe was 100 and the carrying amount at the end of the year is 120. So which means this increase is now the fair value adjustment, which if the question requires you to disclose the investment property in the profit and loss, you now take this 20 to the profit and loss under income. So that's basically how you treat the questions. I want us to do the long question. If we take time doing this small question, let's just look at what are we going to do on this one. Right. So which means here we're going to take out the VAT, am I right? On the cost price. We're going to take out the VAT. Then after we take out the VAT, then we add this and this and this one. So this is going to be the cost of the investment property. So we need to take out the VAT, then we add all these to come up with the cost. Then this one is now going to profit and loss as an expense. It's not part of the cost of the investment property. The question was requiring us to calculate the initial cost at which the investment property must be recorded. So which means these are the initial costs. You need to add these, but also take into account the VAT implication in the cost of the investment property. The company is a registered VAT vendor, so you need to take out the VAT. When you are taking out the VAT, you just come and say 100 over 115 times 695 400. So that is going to be the cost excluding VAT. It's going to be 100 over 115 times 695 400. So it's going to be the cost excluding VAT. I want us to quickly go to a long question. That's why I'm just trying to jump those ones and explain them. Right? Let's look at how do you measure after recognition. After we recognize the asset, then we are going to measure using the fair value or the cost model. I think we did this when we were doing our PPE. Right? When we are using the, like as I said, FAC 3764, we use the value model to. Can you please mute yourself, please? Who is can you please mute yourself, please? Right. So we use the fair value model. So if you are using the fair value model, what is going to happen? Which means the carrying amount of the investment property is going to increase. carrying amount will increase when you are using the fair value model. And also the fair value adjustment. The fair value adjustment is the difference between the carrying amount and the cost. So that is going to be your fair value adjustment. So that fair value adjustment, you are going to take it to the profit and loss account for the period for which it arises. So which means we take it to the profit and loss, the fair value adjustment. The cost model for investment property is not common. You will see it when you do your further FAC, but this is when we have cost less accumulated depreciation. But you can see that most of the investment property, they appreciate. So in that case, the cost model is not common in investment property. Right, so let's just go through the other activity. Okay, this one we're going to do it. There's something that I saw on it. Okay, we still have time. We can do this one. They say Zelton Limited is a company with a 31-year March end. The following information relates to the assets of the company. Always look for the end of the financial year. It's very important when you are answering your question. Then they say they have a shopping center. On 1 May 2014, Zelton Limited purchased a shopping center for 23 million. That is building 13 million, 10 million for land, cash to be leased to a variety of retail businesses. The fair value of the property at year end on 31 March 2015 was determined to be 26,500,000. That is land 12,500,000 and building 14 million. Then there's additional information which says investment property is accounted for according to the fair value model. The carrying amount of the investment property will be recovered through sale of the property. That is going to affect when you need to calculate your deferred tax. Remember when we said if a property can only be recovered through sale, then it means your deferred tax will now include capital gain, which is going to be 80% times 28%. So in a question, always look for how the asset is going to be recovered. But in most cases, even if they don't indicate, another indication is if it is measured using the fair value model, it means it can only be recovered through sale because it's not going to depreciate to nil. So in that case, you measure it using the fair value model, and the fair value adjustment is now going to attract tax, capital gain tax. Right, so they say the fair value of the land and building were determined by an independent zone appraiser based on current market prices. We are required to prepare all the journal entries relating to the shopping center since acquisition until end on 31 March 2015 in the accounting records of Zelton Limited. Right, so I want us to do this together because sometimes in your questions you may find that they can bring in these journal entries. So we need to be able to do them. What do you think we should record here? Is there anyone who has got an idea of what we can record here in the journal entry? They say prepare all the journal entries relating to the shopping center since acquisition until year end on 31 March. What do you think we are going to record on this journal? Based on the information that we have. Well, these are the kind of questions that you come across in your whatever test or exam. You'll be given with information, then they say record the information in there. So what is going to be what you are going to record here? Anyone with an idea? Where do we start? What are we going to record?
I think the first journal entry is for land, recognition of land and the property against the bank.
Right. Then after that, or you end there. That's where you end.
Then that's also a subsequent measurement whereby we record the revaluation surplus.
So there's no need for us to do it now because you have already answered. Let's do it, the journal entries. So when you have your PPE and your investment property, and they requires you to do journal entries to record since acquisition until year end. So what it means is you are recording at initial recognition. You are recording at initial recognition and subsequent recognition. So that's all. So if the question is like this, then it means you need to take into account what is the cost of the investment property at initial measurement and what is going to happen thereafter, that is the subsequent measurement. So in your journal entries, it means you need to recognize the investment property at initial measurement, and then you look at thereafter what happened to the investment property. So let us just quickly do these journal entries together. Right, so which means on normally your journal entries, you need to record the date. So we need to record what happened on 1 May. So that's the first journal for 1 May. So we're going to record what happened on 1 May 2014. So which means that's the recognition of investment property. You should also look at how did they acquire the investment property. They bought it for cash. So which means our journal entry is just going to be the recognition of investment property. It's going to be investment property. So that's how we do our journal in the statement of financial position. And it is also going to affect bank in the statement of financial position. So that we can combine them. There's no need for us to, because remember here the question says the shopping center. So we can combine everything for the shopping center. Okay. So which means we're going to have 23 million here. And bank 23 million. Then this is recognition of investment property. So that's our journal one. We recognize investment property. Then subsequent measurement. So which means this is the initial measurement on journal one. Then after we do our initial measurement, then we need to do the subsequent measurement, which is going to be on 31 March, the end of the financial year. Let me just check the financial year end on 31 March. Right, so now we need to record what happened at the end of the financial year, which is 31 March 2020, 2015. Right, so since we are talking of the fair value measurement, so what we are going to look at is the increase in the carrying amount of the investment property. So the investment property increased from 23 million to 26 million 500,000. So that's what you are going to record. You are going to record the fair value adjustment. You are going to record the fair value adjustment. So which means here, the fair value adjustment is going to increase the investment property. It's going to increase the investment property in the statement of financial position, and it's going to increase fair value. Is it? Yeah, fair value adjustment. So the fair value adjustment is now going to increase in the statement of profit and loss. So which means we're now going to have our 26,500,000. That's the carrying amount after fair value adjustment minus 23 million. So this is what we are going to record at subsequent measurement. So which means it's going to be 3,500, 3,500,000 here. 3,500,000. So that's how you record your journal entries. If they ask you to record at initial measurement and subsequent measurement. How about if it was a PPE? How are we going to record it? Let's say this property was PPE. We can come up with anything on how we can record if it was a PPE asset. Initial measurement and subsequent measurement of a PPE asset. Speak up, speak up. Hello? Is there anyone who is giving an answer, or it's a background noise that I can hear? Okay, if it is PPE, at initial recognition, which means you need to check the cost of the PPE, the same we did the investment property. But at subsequent measurement now, you need now to check depreciation, which means we should have depreciation journal here if it was a PPE. Instead of a fair value adjustment, it means we're going to have a depreciation journal if it was a PPE. So if the question requires you to journalize, which means you should just look at the initial measurement and the subsequent measurement. Those are the things that you are going to journalize in your journal entries. I don't know if there is anyone with a question before we go to something else. Anyone with any question before we go to something else?
I would like to ask whether are we not supposed to separate land and property when it is when it comes to investment property, as we do in PPE?
Investment property, you combine them, just become investment property as a full amount. In PPE, remember we separate them. You can even separate if you want. Let me just go there, but it's not necessary. You can even separate like here, which means you record one by one, but it's not much necessary when it comes to investment property. Because remember, investment, the reason why mostly we separate land and building is because you will find that the land does not depreciate and the building is depreciating if it is a PPE. So which means we need to work them separately. So in this case, all of them are appreciating. So there is no need to separate in the exam, because you will have to spend a lot of time trying to do for land, trying to do for the other journals. So there is no need if it is investment property. You can just combine the two. Right. Any other question before we go to exchange of investment items or property? I think this one is the same like what we did before. There's no need for us to look at. In exchange, under AIS 40 is the same as under AIS 16. So that's how you treat an exchange, which means there must be a fair value. If there is no fair value, then you are now going to exchange at the carrying amount of the given up asset. Remember what we did when we were doing PPE. So which means if the fair value has been determined, then it means you are going to exchange using the fair value of the given up asset. But if no fair value, then it means you are going to determine the cost using the carrying amount of the asset that is given up. So which means in your question, you should have either one of these and the fair value as well, so that you can be able to determine the cost of the investment property. But let's look at when we do our transfer. Mostly when you transfer investment property, it's either you transfer it to PPE or to non-current assets held for sale. You can transfer it to PPE or to non-current assets held for sale. So what is important for you is to know the value that you transfer. So which means you are going to take the carrying amount of the property transferred. So that's what you are going to. So which means at the end of the year, if the investment property is now going to be transferred to PPE, then you just come and look at the carrying amount. Then that's the value that you take to the PPE. Even if we have to transfer it to non-current assets held for sale, it means we are going to take the carrying amount of the property transferred. But there's a situation here when we have impairment loss. Impairment loss. So if there is impairment loss, then it means you need to bring it down again from its carrying amount by the amount of the impairment loss. So that is the value that you are going to transfer. As long as the asset has been impaired, then you need also to take out the impairment loss. Then the carrying amount after impairment loss is the one that you take to transfer. I think we're going to, that will be our next topic, impairment loss. That is AIS 36. We're going to look at it in our next class, AIS 36. Right, then when you are using the fair value model, you take it at fair value. So which means you are going to take it at what? At fair value, if you are using the fair value model. The fair value after you add the fair value adjustment is now the value that you transfer is either to PPE or to non-current assets held for sale. I think we're also going to do this one. It's no more in AIS. This one is International Financial Reporting Standard 5. I once asked a question, the difference between AIS and International Financial Reporting Standard. Who can have an idea of the difference? Remember, I once asked this and I asked you guys to take it as a homework and research on it. Who has come up with the difference between the two? Anyone who has come up with the difference between AIS and IFRS?
I think AFRS was modified, was updated from AIS.
Okay. Anyone else who can come up with the difference between AIS and International Financial Reporting Standard?
I think the IAS is the earlier version of the accounting standards, while the IFRS is a more up-to-date and widely used version worldwide.
That's 100%. So if you look at AIS, this is the old one. AIS are the old standards. So these one are the ones that were the new standards. So if you see a International Financial Reporting Standard, then you know it's a new standard. If you can check, we have you can see we have AIS 16 and we have 16. So you can see this one is the new standard that was upgraded. That's what she said. There is 100% correct. So more or less, the International Financial Reporting Standard, these are the new standards that have been upgraded. So that's the only difference. But so whenever you look at them, the AIS, just know that you are using the old standard. When you use the IFRS, then you know you are using the new standard. Those which has been upgraded by the International Financial Reporting Standard Council. So those are the new standards. Right, then let's look at when we want to recognize. It's either we can dispose an investment property. We can check it from use. So that is going to be derecognition of investment property. Then what is going to happen on the gain or loss on disposal? I think we've already talked about it. If there is a profit, which means it goes to the profit and loss. Remember, when we dispose an asset, if there is any profit on disposal of the investment property, it goes to the profit and loss as income. If it is a loss, it goes there as an expense. Right, so let's look at the tax implication of the investment property. I think we have already, I want you guys to look at this part. That's the only difference between PPE and investment property. So what happens here is, if it is investment property, we say we can only recover investment property through sale. So that's why it attracts capital gain tax. But a PPE asset, we can have a situation where this asset can deplete to nil without us getting any cent from it. So in that case, we don't guarantee ourselves that there is going to be capital gain from that. So SARS will not guarantee that they will get something out of this. So basically, investment property, it increases in value. So that increase in value, it means it can only be recovered when you sell it. There is no other way, like a situation where it can depreciate to nil, but it will appreciate, which means the only way to recover it is through sale. So deferred tax on investment property is going to come from the fair value adjustment. So that's where you take your deferred tax, fair value adjustment. That's where the deferred tax comes from. And don't forget to apply the 80% times 28% on the fair value adjustment. That is going to be the deferred tax on investment property. Right. When it is a PPE, asset, we don't use this 80%. We only use 28%. But if the PPE asset is earmarked for sale, let's say the management is decided that on so and so date, they are going to sell the PPE asset. So that's when it will now attract. You can now use the capital gain on the PPE asset. So if it is a PPE asset, look at what is the going to happen to the PPE. If they are going to continue using the PPE, then it means you only use 28%. But if they are going to sell the PPE, then you can now use 80% times 28%. So in your question, always look at what is going to happen to the PPE. And another thing on investment property, we have investment property like buildings. Building will attract capital gain tax and recoupment. So when you have building, it means on the fair value adjustment, you are going to apply the capital gain tax. But you'll see SARS will now requires you to bring in the capital allowance to that building. So once the capital allowance are subtracted from the building, then it means you also need to have deferred tax on recoupment. You have deferred tax on recoupment. So which means you are going to have two deferred tax here. One, the one for fair value adjustment and the one for recoupment. As long as in a question they specify that SARS allows a capital allowance of so much, then it means you are going to have two deferred tax on that particular asset. So it means you need to have deferred tax on fair value and deferred tax on recoupment. So you look at the question. If the question talks about SARS applying 5% capital allowance, then that asset, if it is investment property, then it means you are going to have two deferred tax from that one particular asset. I think we did something in our previous question when we were answering PPE land revaluation surplus. Right, for today, I want us to look at this bit long question so that we can see how do we apply everything to. Why I don't have the question down here? Let me check. Do you guys have the question below on the notes that I sent? Do you have the question on the notes, or I sent the notes without the question, the long question?
There is a question.
So which means mine here is the one which, so if you guys have it, let me look for one here.
Eh?
I think I have the question. Let me just check it.
Please mute yourself in the class.
Please mute yourself, please. Right, let's look at this question. Let us all look at this question. I think you guys, you can see the question. Right, so that's the question. They say the following information refers to the assets of Investors Limited for the year ended 31 December 2013. These are the assets for the company. There is land purchased on 1 January 2013, 800,000. Right, there is there is also office building. There is also improvements to the building. There is rental income, repairs and maintenance. Then they went on and say Investors Limited occupy 5%, which is deemed an insignificant portion. Here, if they occupy a significant portion, it means you are going to share between investment property and PPE. That is, if the company occupies a significant portion, then it means you are going to share between investment property and property, plant and equipment. Then they say Investors Limited use this 5% of the floor for their own administration purposes, but because it's insignificant, we take the whole property as investment property. But if it was significant now, we need now to share between investment property and PPE. Right? Then the remainder of the building is leased out under an operating lease for 20,000 per month from 1 March 2013. On 31 December, means towards the financial year end, so that's their financial year end, 31 December, an independent stone appraiser who holds a recognized and relevant professional qualification and has recent experience in the location and category of the property being valued the property at the following fair values. So these are the fair values of the investment property. So we have our subsequent measurement on 31 December. We have our initial measurement on here. So this is going to be our initial measurement. Right, then they say the valuation is based on current market prices for similar properties. Then Investors Limited applies IAS 40 investment property on its investment property according to the fair value model. According to Section 13 of the Income Tax Act, SARS allows 5% annual tax allowance according to the straight line on the building. You see what I was talking about there? So which means we are going to have a recoupment tax and capital gain tax on the building here. This allowance is not apportioned for part of the year. The company shows a profit before tax of 450, including all the above information, including, which means all the information from top until here. Everyone who has to increase the profit is in here in this profit. For the year ended 31 December 2013, deferred tax is provided for on all temporal difference according to the statement. Remember, for our FAC 3764, we use the statement of financial position approach, where we look at the assets and liabilities. There is also this statement of comprehensive income. I think you will use it when you're doing your CTA. You can also do deferred tax using the statement of comprehensive income, right? Then they say no other items other than those. So when they talk of deferred tax according to the statement of financial position, you are just looking at the carrying amount of the asset and the tax base of the asset. So which means in your question, you should look at who are those assets, who are assets in the question, who are liabilities in the question. Then you determine your deferred tax from those. So that's basically what they mean here when they say you are going to use the statement of financial position. Right? Then they say the current income tax rate is 28.80 of all capital gain are taxable. Assume that the cost of the property is equal to the base cost of the investment property. So which means our cost is the base cost of the investment property. So here you should look at the difference between the base cost and the fair value is going to be our fair value adjustment. Okay, so what are we required to do is to disclose the following notes to the financial statements of Investors Limited for the year ended 31 December. You see the question, disclose the following notes to the financial statements, which means we need the profit before tax, the income tax expense, including the tax rate reconciliation, the deferred tax, and the investment property. So we need to disclose all these notes. We need the profit before tax, the income tax expense. So from your AIS 12, I think you guys, you know, if the question says the income tax expense, including the tax rate reconciliation, what is required there? It means we have those two major components of tax. We are going to have deferred tax and current tax. Once they talk of the income tax expense note, it means you are going to have deferred tax and current tax. You combine them, then they will give us the income tax expense for that particular year. Right, then deferred tax is what we will have calculated there. So where do we start? The first one is the profit before tax. We are going to do the notes. So if the question requires to do the notes, it means you need to come up with the heading. This is the name of the company. So that's the name of the company. They want us to disclose the notes. So we're going to have the notes for the year ended. For the year ended 31 December. (2023). The first note is the profit before tax. That's the first note, the profit before tax. What do you think we should have here in the profit before tax? Anyone who can?
The rental.
Yes. Hello?
Hello.
Yes, I can hear you.
Yeah, it's the rent income.
The rent income.
Yes.
Yes, the rent income is going to be part of the profit before tax. So what do you look at now? The rental income is going to be part of. So once the question requires you to do the profit before tax, in your answer, you look at who is income from your question and who is expense. So those are the only things that you should disclose. So if the question requires you to disclose the profit before tax from the information that you are given, you go to your question and look at who is the income and who is the expense. That's basically the only things that you look at. So which means we should look at the income. Who is going to be the income here? The rental income received, am I right? Of 200,000 is going to be income. Okay, so under income, we're going to have rental. You don't even have to adjust the profit given. You just disclose the effect of the information provided in the profit and loss. So which means this one is going to increase the income, right? What else are we going to take again from the information that we have? What are we going to take from the information that we have? We have the rental income. Then the repairs and maintenance is going to be an expense. Am I right?
Yes.
So we take that one. It's very straightforward as long as you understand what is supposed to be done. So which means here we take what are those costs called repairs and maintenance? So the repairs and maintenance is 50,000. So it's going to be an expense. Then you go again to your question and look at income and expense. Remember, our profit and loss is only made up of income and expense. So which means, question, those are the things that you just look when you disclose the profit and the loss. You just go and look at the income increase or decrease in income and the expenses as well. So what else are we going to get? We have repairs, we have rental income. What about this one? The improvement to the building. What are we going to do with the improvement to the building?
It's going to capitalize the building.
Yeah, that one is going to increase the value of the building. It's not going to be, because you can see improvement, which means it's going to add value to the building. So you capitalize that one. So in our profit and loss, what else can we take to the profit and loss based on what we have here?
I think
The
also
fair
have to
value
check
adjustments.
The fair value adjustment. Ne?
Yes.
Yes, we need
Yes.
the fair value adjustment here. So let's look at how are we going to adjust. The land is 800,000 and now it's 1 million. So we have 200, am I right? On the land, we're going to have fair value adjustment of 200. Then the building is now 2,600,000. And here is going to add up to, we add these two, it's going to be 2,500,000. So the difference between 2,500,000 and 2,600,000 is going to give us 100,000. Am I right? So which means our fair value adjustment is going to be 300,000. So you just go again and take it as income, the fair value. which is going to be 200,000 plus 100,000, 300,000. So that's how you have disclosed your fair value adjustment. Then you look at anyone else who can be part of the profit and loss. Who else can be income and expense from our question? Anyone who is income here is or expense. I think we are done with the profit and loss. Is there anything that we can take from here? We are done. Right, so which means what? This 20,000 is the one they multiply by 10 to make up this 200. Yeah. Yeah, because it started from 1 March. So it's included in this 200,000. So which means it will be
And
done.
then,
Hello?
yes, and then the 100,000, sorry, I missed it.
Oh, you missed the 100,000, eh?
Yes, yes.
Okay. So our 100,000 comes from here. Remember, this is the initial measurement of the building. It was purchased for 2,100,000, and there was improvement of 400,000. So which means all in all, at
Yes.
initial recognition, the building will now cost 2,500,000. Do we agree on that part? Are we together there on that part?
Yes.
On the 2,500,000.
Yes.
Then there was the fair value is now 2,600,000 at year end. So the difference between 2,500,000 and 2,600,000 will now give us the fair value adjustment.
Perfect.
Okay, so that's there. So always look on fair value adjustment is the difference between the initial measurement and the carrying amount at the end of the year. So that is going to give you the fair value adjustment. So if you are required to disclose the profit before tax, then it means you take that fair value adjustment to income. Remember, profit is all about income and expense. So in your question, even if you have a lot of information in the question, once the question requires you to disclose the profit before tax, you don't have to mind about the quantity of the information. Just look for income and expense from that information. Because I know the FAC and MEC lecturers, they want to give too much information to confuse people. So always just know that I'm doing the profit before tax. So I want income and expense. That's all. So you just look for those from your question. Even if you miss, if it is an exam, if you miss one, but you are still going to get a good mark. So what is important is to know how to answer the question. What information do I need to answer the question? Then from the scenario, you can pick, even if you miss some of the information, but you will see that you're still going to pass because already you know what you want from that particular information. Right? If there is no one with a question on profit before tax, we can go to income tax expense. The income tax expense, we have to include the tax rate reconciliation. I think you guys have forgotten about AIS 12 now, about the tax rate reconciliation, the income tax expense. What are we going to have on the income tax expense? What information? Because that's one thing that is very important in the exam. If you know what you are doing, you are calculating and how to, there is nothing that will stop you from coming up right. So in the income tax expense, what do we need in the income tax expense? Anyone who has got an
Major
idea?
components of
Yes, we need
It's
those two major components of tax. So your major components of tax are going to be current tax. So once you see this income tax expense note, what makes up income tax expense? Which means we should add current tax, you can calculate it on C1, and deferred tax. You can calculate it on your C2. So this will give you the major components of tax. Here they just give them a big name, but what it means, this is the total tax payable. If you see the profit and loss of a company talking of the income tax expense, which means they've added the current tax and the deferred tax, right? So what it means, we also need to do the tax rate reconciliation. They say we should do the tax rate. Remember, the tax rate reconciliation falls under the income tax expense. So we also need to do the tax rate. The tax rate reconciliation. Tax rate reconciliation is reconciling the accounting profit with exempt differences. That's the tax rate reconciliation, which means you are trying to say, I'm starting from the accounting profit. What is going to be my taxable income when I start from the accounting profit? Which means you need now to remove the exempt differences. Exempt differences are those income and expenses that were included in the calculation of the accounting profit, but which are not included in the calculation for tax purposes. So which means exempt difference arise as a result of the difference between the accounting standard and the Income Tax Act. That's the reason why we have those exempt differences. Right, so let's look at, so we're going also to calculate the tax rate reconciliation. Let's just check the question again. So deferred tax is going to stand on its own. But I think we need deferred tax so that we can be able to calculate. Okay, it's fine. We'll calculate deferred tax. Then what else do we need? We need deferred tax and investment property. Right, so let's calculate this. Then we'll for number 2. So for number 2, we need deferred tax and current tax. So let's do our calculation 1. Current tax. Where do we start with the calculation for the current tax? Anyone with an idea of the calculation for current tax?
We are starting with the accounting profits.
Yes, we start with the accounting profit. What you should know about current tax is the tax is what comes from the taxable income. So when you are calculating the current tax, it means you start with the accounting profit, then you adjust exempt differences. So which means you need now to take into account the exempt differences. Exempt differences are those differences in accounting and tax, which means when we calculated our accounting profit, we were using our International Financial Reporting Standard, International Accounting Standard. But when we go now to calculate the taxable income, then the Income Tax Act will now have its own way of calculating. So since you are starting from the accounting profit, we are now saying what is in this accounting profit which is not supposed to be taxable. So those are what is going to be the exempt differences in that case. Right, so which means in our question we'll need the accounting profit first. So let's look at the accounting profit, which is 450 before tax. That is our accounting profit. So 450 is the accounting profit. So who are going to be our exempt difference? Who are those exempt difference? Anyone who has got an idea, what do we, when we look at these figures, who can be an exempt difference? Because we said exempt difference is the different treatment in accounting and tax. So 450, we got it when we were using accounting conventions. But as we want the taxable income, so what are we going to do? Who are going to be our exempt differences? Anyone who has got an idea, who are those exempt differences? I know that you guys, you forgot.
I think it will be
Yes.
the 20% of the fair value.
Yeah, you are 100% correct. You don't even think you are 100% correct. You see what happens, what she's saying, the 20% of the fair value. You can even see it here. This is our profit before tax. Do you see what happened here? We included the full amount of the fair value. But when you go to SARS now, they will tell you that based on their income tax, for calculating tax, we don't include this full amount because this 300,000 is 100%. But when you go to SARS now, SARS will now say, okay, as we only need 80%. Do you see now? Which means here there is 100% of fair value in this 450. But for SARS, they say they only need 80%. So which means that 20% we are going to take it out from here. The 20% of the fair value adjustment, we are going to take it out from here. So which means we are going to have a fair value adjustment. So that's basically exempt difference, the difference in treatment between tax, Income Tax Act and the financial reporting standards. So it's going to be 300,000 times, you can just say 20. But I think you guys, you know where the 20 is coming from. The 20 is coming from 100% minus 80%. That's where the 20 is coming from. I don't know if I want you guys to understand that part. If there is anyone else who doesn't understand that part, I want us to, because when you will see when you do your FHC, that's why I was saying they mix these standards. You can see here we are using AIS 12, but we are doing AIS 40, but we are now coming across AIS 12. So we need, especially AIS 12, you need to understand it because it's integrated in most of our questions. How much are we going to have as our exempt difference? %20 of that figure is going to give us how much?
60,000.
60,000. So that is going to be our exempt difference. Is there anyone else who's going to be an exempt difference? So we are going to minus this. Yes, we minus it. Then what do we have? We're going to have 450 minus 60. 450 minus 60. It's going to be 390,000. What do you call this figure? It's going, we call it
Taxable income. Taxable income. Taxable income.
We're not, we're not, we're not yet there. Remember after
it's a temporary difference.
Is it
profit after exempt?
Profit
Yeah.
before tax.
Yeah, it's taxable income, or we can call it profit after exempt difference. Remember, we're still going. Right? So this is the profit. So which means now we need our temporal difference. Here we're not going to have a movement because we're only dealing with 1 year. So we're going to look at the temporal difference. Mostly when you are doing your investment property, you will not have the movement. Remember, the movement is the one for last year and the one for this year. So this one we're going to have the temporal difference. Who are those who are going to be temporal difference? The temporal difference is now going to be this 80% of here. So which means it's going to be the fair value. Which is 300,000 times 80%. How much is it going to be? $240,000. Is it taxable or deductible?
Taxable.
Where are we? Is taxable? So if it is taxable, what do we do with it? We subtract it here.
Yeah.
We do it the same structure that we do when we are doing our AIS 12. Right. So let's look at the tax allowance is 5% of the cost of the building. The cost of the building is 2,500,000. So it's going to be 2,500,000 times 5%. How much are we going to have as our tax allowance?
125,000.
So we're going to have 125,000. Okay. Then we have our taxable income. What is going to be our taxable income now? We subtract from 390, subtract 340, subtract 240, minus
25,000.
125. So it's going to be
25,000.
25,000. So our current tax is going to be 25,000 times, they say, remember now it's 27%. But when you are dealing with this tax, always look at the question paper. Because even now, when the tax rate is at 27, they can bring a question paper with 28. So always look at what is the tax rate they requires you in the question. So it's going to be 7,000. So our current tax is going to be 7,000. So which means you now go and do your current tax. You fill in the current tax here on calculation 1. With current tax is 7,000. Then you want to calculate the deferred. That's calculation 2. So which means we need the deferred tax. How do we calculate our deferred tax? So which means we look at the components of the deferred tax. What is going to make up the deferred tax? Which means we have the fair value adjustment for the land and the fair value adjustment for the building. Am I right?
Yes.
Or are we lost? Are we lost? Are we lost? Right, so that's there. So let's do our deferred tax. Deferred tax. When you are calculating deferred tax for investment property, there is no need for you to do those boxes in the exam. It will waste your time. You just need to know who are those assets who are going to fall under deferred tax. We have the land, we have the building. Then you look at the fair value adjustment. What was the fair value adjustment for the building and for the land? So which means here you look at the land's fair value adjustment is 1 million minus 800,000, which is 200,000. The building is 2,600,000 minus 2,500,000. So you just now come here and say, under your land, you are going to say 1 million minus 800,000 times what? 80% times 28%. Then you come to the building and then you say 2,600,000 minus 2,500,000. I think you guys, you know where we got this figure. Times 80% times 28%. Right? So that's how you get your deferred tax. But remember, on the building, we have on capital gain and recoupment. We also have a recoupment, which is going to be on building. So which means the building is going, remember we say it's going to attract the capital and the recoupment. So on the building, or when you are doing your recoupment, you look at the tax allowance that was deducted from the building, and then you look at the cost. The difference is now going to give you the recoupment, which is 2,500,000 minus 2,500,000 times the 5%. Where is that 5% here? Times the 5%, the tax allowance. So that's there. So which means you are going to have 2 million I think we understand these three statements now. The reason why here we have 80%, 80%, and here we only have 28%. If there is anyone who doesn't get it, then let's see if we can be able to. So the first one is going to give us how much in terms of deferred tax? It's 200,000 times 80% times 28%. Am I right? So I got here
44,800.
44,800 is a deferred tax liability. Then on the building,
22,400.
on the building.
22,400.
22,400. Hello, you said 22,400.
Yes.
22,400 is a liability again. Then on the recoupment, how much are we going to have here? You need to subtract it. Let's have the difference there.
Yo,
How much
that's
are you getting?
giving me 665,000.
Let's do
No,
it.
let me redo it.
So it's going to be 2,500,000 minus. You remember the 125 we have already calculated it minus 125,000, the 5%. So it's going to give us 2,375,000. So it's 2 million minus 2 million.
Yeah, it is correct. It is 665,000.
You got 86.
Yes, it's 665,000.
Let me just also do it here so that we know we are on the same page.
Yeah, it's 665,000. Maybe we made a mistake on the calculation.
How are you guys calculating it? Me, I'm getting a small number.
Okay, let me try this. 2512 minus.
I'm getting 35,000. First, let's see here. How much do we have here? Oh,
You made a mistake there. On the the way you presented your calculation there. That's where there's a mistake there.
It's 2 million. All right, okay. I see it's me who's confusing you guys. So it must be 2,500,000 minus 2,500,000 minus this one. So which means when we have our 125,000 here, we minus it from 2,500,000. Then the figure that we have is now the one that we minus from 2,500,000. Then we multiply by 28%.
Or we can say minus 2,500,000 times 0.95.
You say minus 200,000, 2,500,000 times. Is it going to give you the same? Because me, I'm getting 35 here.
I'm also getting 35,000.
You now got 35. No?
Yes.
So which means the 35 is now confirmed correct. So our deferred tax is going to be, they are all liabilities, am I right? So which means they are all deferred tax liabilities. So we just need to add now. Then we go and take it to the major components. How much are we going to have if we add?
Guys, I don't get the 35,000. No.
You didn't get 35.
It's 665.
I'm getting 102 here.
Okay.
Who is not getting
We're
35?
getting 6,500.
It's 665. It's not 35,000.
It's 6,500.
6,500.
Yes.
No. You
Right,
need to
you guys, what you
recalculate
do
that
here,
presentation.
let's look at here. What you are going, how you are going to calculate it is here. Remember, I've amended here. No? Just make it like this. 2,500,000. You subtract
5%.
this one. 2,500,000 minus 125. You subtract it from here.
I did that. You get 1,375,000. Then you times it by 28%. It's 665.
Solve the bracket first.
Solve the bracket. That means
I
that.
did that. Yes, the bottomless rule. I did that.
Okay,
If you do
let's do
I
it
don't know if
together.
it's my
25.
calculator or what.
Okay, let me do it this way.
It's like what you do 25 million, you minus 125,000. You'll get 2,375,000. And then you do 25 million minus 23 million. Yes. It is. Check it. Solve for X.
Right. So that's the thing here. So which means we first need to get this. So the first one is this one. 5% is going to give us 125,000. Am I right? So you subtract 125,000 from 2,500,000. How much are we going to get?
2,375,000.
375,000.
375,000. Then we now
Yes.
say 2,500,000
500,000
minus 2
And
million
now it's making sense.
times 28%.
Now it's making sense.
Yeah, so that's how it should look like. So you see how we get it's me who wrote it in another Greek way there. So it was, yeah.
Oh, okay.
Yeah. So we now have a total of 102,200. So we take it to our deferred tax. So it's going to be 102, 200. So our income tax expense is going to be the addition of these two. So it's going to be 100 what? 9,200. Am I right? So you'll be done with your major components of tax. Then what do we do on the tax rate reconciliation? No? I'm having a class now. I'll call you after my class. Okay. What are we going to do with the tax rate reconciliation? What information, in fact, do we need in the tax rate reconciliation?
We need the 28% of the amounts.
Of which amount?
The accounting profit.
Yes. What do you do on your tax? What is that? Remember, I always say the current tax and the tax rate reconciliation, they use the same information. So if you know how to do your current tax, then there is nothing that will stop you to know how to do the tax rate reconciliation. In the tax rate reconciliation, the only difference is we are no more going to say 450. We say accounting profit times 28%. Then in the exempt difference, we are no more going to write the full amount here, 60. We are now going to say 60,000 times 28%. That's the figure that we take here. So which means the figures now that we take here in the tax rate reconciliation is after we apply the tax rate. So which means it's more or less to copy. If the question requires you to do the tax rate reconciliation and you have already done the current tax, there is no need for you to go even back to the question. You just go to your current tax. Then you take the accounting profit, which is going to give you the standard profit, standard tax, which is going to be 450 times 28%. So that is going to be your standard tax. Standard tax is from accounting profit. So which is 450 times 28%, which is 126,000. So you now need to adjust this 126,000 by exempt differences. Exempt differences. Right. Your exempt differences now, we have already calculated them, but when we calculate them, we have 60, which means now we apply the tax rate on 60. So that is going to be our exempt difference, which is going to be fair value. So our fair value adjustment is now 60,000 times 28%. The same way how we treat this when we're doing the current tax is how we are going to treat it here. So how much are we going to have if we apply 28% of 60,000?
16,800.
16,800.
Yes.
So what are we going to do with this 16,800? I have already answered you. So I have already put the bracket. We are going to subtract it. Anyone who can tell us why are we subtracting that 16,800?
It's an adjustment.
What do we want to get? Adjustment to get what? Yeah?
To get the tax expense.
To get the tax expense, okay? So which means, okay, to get the tax expense, so we're going to have the tax. How much are we going to have is our tax expense there? It's 126,000 minus 16,000.
109,200.
If your tax rate reconciliation and this tax expense are different, then it means something did not go well. The tax rate reconciliation and the major component of tax must give the same figure. So if you see that they are different, then you should know that there's something wrong that you did somewhere. So that's basically, and that's why they call it the tax rate reconciliation. You are just trying to reconcile based on the tax rate. But in another way, it means you are still working on the current tax. You can see here what we did is here. We're working on the current tax calculations. The only figures that we did not include are the movement in temporal difference. So that's how you do your major components of tax. It's still the same like the AIS tool. So let's finish off and see deferred tax. I'm sure we've already done it. Let's do investment property. Investment property. Let's do the investment property. So it's going to be our number 4, investment property. Right, what are we going to do with the investment property? What are we going to say about the investment property? Investment property and PPE are the same. You treat them the same way. You treat them the same way. Which means you need your, here we have land, you can, and building, or you can separate them, still the same. Right, we have land and building. So the same way you do your PPE is the same way. So which means you need the carrying amount at the beginning of the year. Then you need, if there was any addition during the year, then you can also have addition from expenditure. And then now you can have your fair value. Then you can now have your carrying amount at the end of the year. Right, so that's how you have to before you even start answering, before you even look for figures, I always prefer to have this. So that I now know when I go to the figures, I'll just look at the carrying amount at the beginning of the year. What was the carrying amount of the investment property, including which the building and at the beginning of the year?
$800,000.
It was lent right there. Okay. There's
Or is 2,900,000.
because we are going to combine them.
Yes.
So it's going to. What about these dates? What are we having on? What is this? What is the financial year for this guy?
31 December 2013.
Okay. So what can we call this? Are we going to have the carrying amount at the beginning of the year, or we don't have? We only have additions during the year.
We've got
I think
addition.
let's have the carrying amounts at the beginning because we
Huh?
don't have a closing amounts. We do not have the carrying amounts at the beginning.
So we don't have, yeah, we don't have
We
the carrying amounts. We only have something that come up during the year. So our 2,900,000 is now going. So that's another key area. You will lose a mark if you come here and say, if you come here and say the carrying amount at the beginning of the year, if you have a figure here, then it means you will lose a mark there. So which means we have addition from acquisition, which is 2,100,000 plus 800,000. Is going to give us 2,900,000. You will lose
900,000.
you will lose a mark for carrying amount is something that you bring from last year. So if something is for that current year, then it means you did not have the carrying amount when you started this current year. So that's another key area so that you don't lose marks. Right, then addition from expenditure is that 400. Am I right? Is that 400?
Yes, the improvements.
Yeah. Right. Then when you are here now, once you arrive at the fair value adjustment, I will prefer you to go to the carrying amount at the end of the year. So which means you just go and look at the carrying amount at the end of the year. Then the carrying amount at the end of the year and the cost will give you the fair value adjustment. So which means our carrying amount at the end of the year, we're going to add these two, am I right? Which is going to be 3,600,000. 3,600,000. So our carrying amount is going to be 3,600,000. So from this carrying amount now, you can now have your fair value adjustment. You can just come here and say 3,600,000 minus 2,900,000 minus 400,000. Right? Then it's going to give you the fair value adjustment. I think we have already calculated it. It's 300,000. Yeah, it's going to be.
Yes, it's 300,000.
Yeah. So you see, it's not even something that is much complicated. Just understand this skeleton of the answer. When you are doing your investment property, understand the skeleton of the investment property and the skeleton of PPE property, when you are doing your PPE property, you will see that you will not lose a lot of marks as long as you know what to fill in here. The only problem comes when you start to struggle with this skeleton. Then it means there's going to be a problem because you are now having two challenges. One, to look for the figures, and one, to determine how do I put my skeleton. So that's all about investment property. In our next topic, we are going to look at impairment loss. Right. Another thing, when are we writing test 2?
14 June.